Something very pivotal is happening to the Smart Grid ETF. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we go here to the industrials, and specifically, Smart Grid. And there's a 72% move from the low and 1.8% away from the 52-week highs. You see here that the average performance of the industrials is pretty good. Weakest is advertising and marketing technology, and we have seen a huge move from the low here in this shipping business. When making this video, I was deciding between either looking at the space exploration ETF or the smart grid. There is something interesting happening with this space exploration ETF, and that is that we are testing the 20-week moving average vigorously. But there was simply more to talk about when it comes to the Smart Grid ETF. So here is Grid. So the name of the ETF is First Trust Nasdaq Clean Edge Smart Grid Infrastructure Index Fund. So an extremely cumbersome name. So here is the very long-term picture with weekly data points. So we do have these major time cycles, within which there tends to be smaller time cycles. So you can see that there are these three smaller within. And the major time cycles, they have been relatively good at calling price movements, and the small time cycles have been good at offering a nuance to that bigger picture. So price is currently, right here, part of this major rising time cycle, and then we have this small time cycle within. There is an expectation that we will see some decline here towards the late part of August before another small rising phase begins. When we compare the small time cycle with the seasonality, we do see that May, June, August, September, they are weak months for the grid ETF. July tends to be strong, but generally speaking, we are in a more mediocre period for this ETF. And that fits very nicely with what we see here with the time cycle. The new rising phase, it goes up here towards the late part of the late part of this year and early into next year. And that's something that fits with the seasonality, because October, December, January, and February, they tend to be strong seasonally for the grid ETF. So basically, the time cycle and the seasonality, they corroborate each other. So yes, there's good reason to expect some pullback at this point. When we look here at the PPO, which measures the distance from the 200-week moving average in red, high PPO did call this mid part of this major time cycle. We did make a higher high here. So this major time cycle, it wasn't as clean as we had here. But even here, we did see that we formed this high towards the middle of the major time cycle, but then we did have that other push as part of the third small cycle. But in this instance, that other push was very, very strong before we did have that complete collapse during the lockdown plunge. So there are certainly some risk signals here when it comes to the PPO. And when we look at RSI, there's a tendency for us to pull back to the low part of the RSI here during the declining phase of the time cycle. So let's go here to the daily data points. And another thing to be aware of, when we look at the previous major rising phases, is that in this instance the purple 20-week and the 50-week moving average were the key momentum moving averages. In this major cycle, you do see that the 20-week had the key role, and when we lost the 20-week, that is when the decline really began to accelerate. And we are currently using the 20-week moving average. And you see that we are testing it very vigorously. And so the thing about these support levels is that when we test them, we ideally want to see a rally pretty darn soon. Because the more you test a support level, the higher the probability that it actually will break. So here on the daily data points, if we zoom back a bit here, notwithstanding the recent consolidation, we still are very far away from the 200-day moving average. Looking here at the historical data on the PPO, RSI has cooled down into the neutral territory. Looking here at accumulation distribution, we definitively see that it's moving up substantially. So institutions are definitively getting very big into the smart grid space. And given the major ESG requirements for mutual funds, hedge funds, ETFs, there's a decent probability that the next declining phase, both when it comes to the small cycle and also the major time cycle, it could be more shallow than what we have seen before, because there is this constant inflow of money. But notwithstanding that, there's good reason to expect a pullback. Looking here at Finwiz, they do like to draw these trend lines. Yeah, we are above the trend line, but there's nothing. It's not like a super interesting trend line. When we compare the grid ETF with the XLI, and XLI is the industrial spider ETF. When we're looking here at the price earnings, you see here that grid is significantly higher. So the XLI is the PE, price earnings ratio of the XLI, is minus 21% below grid. So let's look a bit at the holdings. So here are the companies. So very similar numbers. So 71 here for grid, 75 for XLI. So based on these holdings here for grid, I like what I see, because it certainly looks like this is an authentic ETF. And one of the big problems with ETFs that give you supposedly give you exposure to some interesting theme is that there are major issues when it comes to the holdings. So here with the market cap breakdown, yeah, we do have some mix, but certainly dominated by the large caps. We've got some balance here between the regions. Yeah, it's nicely diversified, especially when taking into account how specialized it is. So the assets under management is $383 million US. So quite minuscule compared to the XLI. So to sum up my take here on grid, I do think that this is obviously a very interesting theme. What we need to be aware of is that the time cycles and the seasonality, it did tell a message, and also with the price earnings is that the price of the ETF, it has run significantly, and so there probably is some need for the companies within the ETF to actually catch up, to make enough sales and to grow to a point where the price earnings of the companies is more reasonable. And a pullback in this space would be very healthy. It's very important to have these frequent, inhales, exhales, inhale, exhale, like, an organic, healthy, well-functioning system. So yes, the next, move is most likely to the downside, but the downside will probably be, more shallow compared to what we have seen before, given the huge inflow of money that we saw in the accumulation distribution indicator.